This segment is going to discuss the use of the double declining balance method of depreciation expense. Recall there are three methods to calculate depreciation expense. There's the straight line method, the units of production method, both of which were discussed in a prior video, and finally the declining balance method. Remember that regardless of which of these methods that is used to calculate depreciation expense, the adjusting entry at the end of every accounting period to record the expense will always be a debit to depreciation expense and a credit to the contra asset account accumulated depreciation. Using the double declining balance method, let's assume that on December 31st, equipment was purchased for $50,000 in cash. The equipment has a 5-year estimated useful life and an estimated salvage value of $5,000. Using the double declining balance method, what is the depreciation expense for year one? So the first step in calculating the double declining balance method is to first calculate the straight line rate, or the amount of the asset's cost that is depreciated each year under the straight line method. The straight line method is evenly allocated over the asset's life. The way we figure out how much, or the percentage, is to take 100%, divide by the number of years of useful life. 100% divided by 5 means the straight line rate of depreciation is 20%. So the double declining balance method says take that straight line rate and double it. Multiply it by 2. So 2 times the straight line rate means the declining balance method rate will be 40% per year for this asset. So the final step to calculate the depreciation expense for the year is to take the double declining balance rate of 40% and multiply it by that year's beginning book value. Recall, to calculate book value, we take the asset's cost and subtract out any accumulated depreciation. This is the first year of the asset's life. Its cost is $50,000, and because we hadn't previously depreciated, it had a 0 accumulated depreciation balance. So when we began year one, the book value was $50,000. So the double declining balance rate of 40% times the original or beginning of year book value of $50,000 means depreciation expense for year one will be $20,000. To record it for year one, debit depreciation expense for $20,000, credit accumulated depreciation for $20,000. For year two's depreciation expense on this equipment, we take the double declining balance rate, which doesn't change. It stays the same, so we don't need to recalculate it every year. We take that rate of 40% and multiply it by year two's beginning of the year book value. The cost was $50,000. We started year two with accumulated depreciation of $20,000, which was year one's depreciation expense, meaning the book value for year two started at $30,000. 40% times $30,000, year two's depreciation expense will be $12,000. Year two's journal entry, debit to depreciation expense, credit to accumulated depreciation for $12,000. For each year of the asset's life, we will take its beginning of the year book value, which for year three will be $30,000 times the 40% depreciation expense for year three of $7,200, bringing the balance in accumulated depreciation up to $39,200 and a book value at the end of year three of $10,800. Year three's ending book value becomes year four's beginning book value. So we multiply the $10,800 times 40% to get year four's depreciation expense, bringing the balance in accumulated depreciation up to $43,520, and the book value falls to $64,80. If we were to just do the formula in year 5, we would take our declining balance rate of 40% and multiply it by year 5's beginning book value. We ended year 4 with a book value of $64.80 and started year 5 with a book value of $64.80, $2,592. If we were to record that much depreciation expense in year 5, we would cause the book value to fall below the $5,000 salvage value. So what we need to do in the asset's last year life is to compare its beginning of the year book value. We ended year 4 with a book value of $64.80, so we began year 5 with a book value of $64.80. We compare that beginning of the year book value to its desired ending value, which is the salvage value, or $5,000. So the maximum depreciation that we can record is $1,480. We force the depreciation in that last year to be such that we will allow the book value to equal the salvage value. So year 5's depreciation expense will be $1,480, bringing its balance in accumulated depreciation up to $45,000, and its book value will be $5,000. This is the only trick to the declining balance method. We need to watch the last year of the asset's life. Don't use the formula. Just look at the current beginning of the year book value and compare it to the desired ending of the year book value. And the difference will be depreciation expense.